Okay, this is my portfolio review from this year. I just want to have accountability for where I want to go with the portfolio. So this includes a brokerage account, Roth, and then here's the total. Um, yeah, the gain and loss doesn't really matter. Uh, just the total. So Microsoft normal account, I have a little over a share. Roth, I have a little under half a share. Um, I just want them because they're big tech and they they just provide a lot of services. Everyone uses Windows. Netflix, um, little under half a share. Um, yeah, they're not quite as much big tech, but a lot of people use them, and they're a subscription service, so their revenue's more consistent. And then this year they also started. They provide more, so they added more subscription options, so that'll help them earn money. Kroger, just big retailer, or like maybe not retail, but consumer goods. They have a low payout ratio and a low PE, or like relatively speaking. Um, and they have a 2% dividend, so I'm just hoping it'll grow. But I have about 10 shares between both of my accounts. Tesla, um, this one's pretty risky. It's only up because Trump was elected. Or that's a big reason it's up recently. Um, yeah, EV vehicles could be used in the future, but they're still not there yet. Coca-Cola, pretty consistent. Doesn't really provide too many growth opportunities, and I think too many people are buying it, or it's just not growing fast enough because it's a stable company. So yeah, nothing much has changed for that. I had three shares. SoFi, I have about 10 shares in my normal account, 20 in my Roth, and I'm just hoping they have a dividend eventually. They're a banking company. Um, yeah, so I think that's their main source of revenue. And with the Trump administration, I think it's less likely for there to be more um, waiving of loans. So people have to get their loans somewhere. Yeah, I think SoFi will do a lot with that. Um, yeah, I just think uh, I can pay whatever price now, and then a dividend will make it up later if they're successful, but there's risk there. McDonald's, uh, yeah, not too much to say. I have about half a share between both accounts. Um, just fast food pays all right dividend. General Mills, this is like a bunch of cereal and snack food. They have a kind of high dividend, um, but their payout ratio is not super low. So I have about 6 or 7 shares. Amazon, I have about half a share, just big tech. AT&T, a little over 3 shares. I just bought it when they had an issue with wiring a few years ago, and they dipped like a bunch in one day. Uh, yeah, and they had a high yield. I think they had an 8% yield on, yeah, 8% yield at that time. Chewy, online pet food brand. Um, this one's a little bit risky because they only do stuff online, so they'll they're basically Amazon but for pet food specifically. Um, yeah, Chipotle, fast food. I bought them when they switched or they got their new CEO, and the old CEO went to Starbucks, because that doesn't really change their business model. Meta, just big tech. Um, Yeah, they have a lot of social media platforms. Pepsi is a new one I got or I bought. Similar to Coke, they just have a slightly higher yield with a similar payout ratio. So I thought it would be a better deal for them just based on that. And they're at a year low, or in the past year, they're at um, pretty much their lowest. Apple, I don't really like their business model. Uh, I think other companies do better products um, in terms of like technology, but I think it's good to just have a bunch of the big tech companies. Yeah. Intel, I might get rid of them. Yeah, so they just do they mainly do computer um yeah, CPUs, the processing units, but uh GPUs have been used a lot more um because they can be used better with AI, or they can be like programmed more specifically for those uses. Yeah, they cut their dividend, so their prices dropped a bunch, and yeah, their earnings haven't been too good. Wendy's just fast food. Their payout ratio is pretty high. It's pretty much all of their earnings. And yeah, right now, a lot of fast food places are doing deals. Yeah, I have 4 shares total. Google, just big tech. Mostly search engine, and then you have YouTube, and they have some AI stuff. Which AI, yeah, I think they could use AI more than other companies, at least with the end user. Nvidia, I don't really have much. I have a tenth of a share. Um, yeah, they're the main driver of the AI technologies. Kohl's of 26 shares. They have like a 14% dividend yield, and I think even if that were cut in half to 7%, because it would be paying out too much, it would still be a good buy. Um, but yeah, 14%. If they don't cut it, then that's just such a high dividend. I I can't like not take that. If that makes sense. Like just having such a high dividend. They've only cut their dividend during COVID, and that's when they would have had a decrease in sales. But right now their sales are just inconsistent um because of their business model. So hopefully their Q4 is good, and that can usually cover the most of the dividend payout. But yeah, even if they have to cut their dividend um, from $2 a share annually to $1 a share, the yield would still be really high, and I would be fine with this price. They're also pretty much at their 52-week low. Petco, uh, similar to Chewy, they have some online stuff, but they also have stores. Um, they've been struggling, but they haven't ever really found footing. Yeah, I'm just betting that they'll do all right. They're trying to get vet services, I believe. Yeah, they're trying to get vet services, and yeah, some of their products are too expensive, so people aren't gonna buy them. But um, yeah, and then Abercrombie and Fitch. This one's pretty volatile, or like just day to day. Uh, they just sell clothes, and yeah, they don't have a dividend. Yeah, I have a little under half a share. Considering buying more, but I'm not sure. There's similar stores like Gap. Um, who have introduced dividends recently, or like in the past year. So I might look towards those because those have pretty low payout ratios, and I think they could grow a bit. Um, yeah. Here we have Ross Dress for Less, another clothing store. This one will pay out a dividend, and they've been increasing it pretty consistently at about a quarter of a share. So yeah, my goals for the portfolio in this next year are looking at dividend growth companies. So that means like something like Kohl's. While that dividend is great, if the lifetime dividend, uh, like for the yield on cost, can exceed 14% through growth, then that would be a bad investment. But yeah, and then I'm looking for like conservative price to earnings because right now the market is pretty overpriced. Um, yeah, I think the prices are gonna come down in the next like few years, probably by 2027 or so. Uh, just because of uh, the presidency being close to over, um, so there's fewer strings to draw, and yeah, just the overpricing. And a recession is somewhat due. Um, COVID doesn't really count because people just saved a bunch of their money, and then stimulus plus savings caused prices to increase really high during that time. So then the drop after, I don't think it really counts. And then yeah, I'm looking at retail value companies, so like the Gap or stores you might see in the mall. Some of those with dividends because they have low price to earnings, and yeah, if they then start introducing dividends, usually companies will increase them after a year or so, and those first increases are typically like the biggest quote unquote. Um, they'll increase the yield by some amount, but since it's so low already, uh, relatively it's a much bigger jump, which could also increase the value of the stock itself. And then yeah, looking at technology growth companies, so that's just big tech. Because yeah, those have been pretty consistent, and they're probably going to shape everything that's used later. And then I just have a few cumulative stock goals. So I want 40 shares, and this is all in the Roth account. So I want 40 shares of Kroger. So I need like 35 more. Uh, and I think they're just a good long-term investment. Uh, yeah, they're if there's inflation, they are the inflation. Um, or they could be because they can raise their prices a little bit, and then yeah, and then 125 shares of Petco. I just want to increase how much, not leverage. I'm not sure if leverage is the right word, but if I have more shares, the upside is bigger. So if they increase by $1, that would be a lot. That would be a 25% gain. But if they increase by $1, then I gain $100. Um, and they're probably not going to go down too much. Like I don't. The stock isn't very expensive, so that would be like maybe like a $500 loss if it went to zero, um, which it could, but probably not for a few years if it does. 50 shares of SoFi. Yeah, like I said, with the dividend, I think long term that would be good. And those are my three main ones. I have a few others just for balancing. I added right now. So three shares of Microsoft. So I need 2.5 more shares. I think Microsoft, maybe not. It's close to a good, a good price, but if it's under like right now it's kind of cheap. I think under 450 or $460 is pretty cheap, because they have a dividend, and they're just a solid company since they have they've pretty much cornered the games market. Yeah, like I said, they have Windows, and they also have some cloud services like Azure, but I don't think that one would be used as much. Yeah, and then even though they're one of the bigger companies, I think they provide more value than something like Apple. Um, yeah, maybe. Yeah, and some of the other ones are harder to compare to because they have their own unique thing. Google with a search engine, Amazon with online retail and web services. Um, yeah, and then Ross, that's just another consumer discretionary. And I think, yeah, I need to research that one more, but I think I think their dividend could grow a little bit, and they're probably fairly priced right now, or a little bit expensive. But since they have more opportunity to grow, I think they're better off. Um, yeah, that's why I'm not really going for Kohl's. Because right now, even though they're much better, uh, after a certain point, they'll be worse off. And then Kohl's is also pretty risky. And that's it.